Good evening from Baltimore. This is Alastair Williamson. Today's the 6th of July, 2017. What is on our minds this evening are cryptocurrencies. What we're seeing are specific tradable technical patterns that we believe could lead to an upward thrust, especially in Bitcoin, looking at the symmetrical triangle, this rotation of a symmetrical triangle contracting wedge, that we are very near and close to the apex, which could signal a breakout on an intermediate time frame, which would then lead to an upward thrust, possibly in the 3,000 mark or even higher. There are some Fibonacci levels that we have that could even see the 3,700 level. What we're seeing, and some very interesting trends that we're picking up, is that there are funds that are being created right now that are going into cryptocurrencies. Basically, what that means is that Wall Street is leaving and they're going into cryptos. They're taking their money out of New York and going into cryptos. What we believe, and we could see a major trend over the next few years, are that basically sovereign wealth funds, pension funds, insurance companies, very large financial institutions out there getting cleared with compliance, starting up these funds, and maybe going out there and actually taking part and buying into this cryptocurrency trend. Many individuals are trying to shelter from this central bank manipulation that we have seen over the course of the cycle, or even for the past many of decades. There is a fright out there that we even see in today's market of stocks and bonds selling at the same time, which is sort of rare, and it signals that people are just dumping their money out of equities at all-time highs. And that is very concerning. And it's systemic too, because we not just saw it here in the US today, we saw stocks and bonds sell in Europe as well. We saw stocks and bonds sell in Japan as well. So it's a systemic threat that we have, that these financial markets that are printing at all-time highs are drawing down. Now, what's very important to understand, and why we could see an inflow into cryptos in the very near-term time frame, it's basically central banks have come out in the recent weeks, especially the BOE with Mr. Carney and the ECB with Mr. Mario Draghi, coming out and going from a dovish standpoint to now hawkish. Even we saw the likes of the Fed with 4 members in the past few weeks, including Yellen, coming out and talk about these lofty asset prices here in the U.S., which makes us believe that this collusion between central banks around the world, they've understand that the marginal utility of quantitative easing is pretty much dead. Basically, the marginal productivity of debt is dead. We are basically in an airplane. We have stalled. The nose is pointed to the clouds, or the sky, and what we're going to do is we're going to grab the yoke and we're going to slam it forward to point the nose back to the ground so that we can get out of this stall. And that is what central banks are coming to the conclusion today. We are reversing course, taking the punch bowl of monetary policy and all this easy, cheap money, and we're taking that away from the party. Well, guess what? You're going to get those who've been partying in this entire cycle, you're going to get them very irate or very pissed off, and you're going to see withdrawals. So let's be careful and understand that central banks are doing this on purpose. They're bringing down asset prices. They're drawing down asset prices. They're forcing market participants to sell stocks, and ultimately it's selling bonds as well, which is even more dangerous. What you're doing is you're unwinding risk parity funds out there, which are trillions of dollars in this strategy. And what we could see is a flow into cryptos from Wall Street. That's what we're watching, and that's why we say prepare for a breakout. Let's transition to the technical side of cryptocurrencies and understand what we mean by this symmetrical contracting wedge.
Transitioning onto the technicals of Bitcoin, what we have is an Elliott wave theory that may indicate price over 3,000 on wave 5 in the very near term time frame. Let's break down this 1, 3, and 5 impulse and 2 and 4 contraction of the Elliott wave theory and understand why we think the next impulse is imminent. So let's understand that the chart is on a daily time frame dating back to the second half of 2016. What we have seen was a run up from about the 800 handle in late December all the way up to early January to about the, we'll call that the 1,150 level. That was the first impulse wave. Then we saw a contractive wave into the mid-January part of, we'll call that the low of like 730, 735. And then from that mid-January part, we saw a third expansion wave lasting all the way up to about June, and that was around the 3,000 mark. So that was a very long impulse wave that we saw. We can see subcomponents of this wave that are definitely visible. But what we want to understand is today and what is happening after this third wave, and we call this a symmetrical contracting wedge. And what this basically means is that the price is compressing. Imagine a spring. You can see the inner components here of this formation, and it's a spring that is compressing. There's a lot of energy, guys, built up in this triangle. Energy has to go one way. Now, it can go another way, but we want to understand that it could go to the upside, and this energy will be very, very explosive. We have targets. If this fifth wave is not thwarted, we have targets of 3768 on a 1.618 Fibonacci extension. How we measure that is from the high of 3003 down to the low of roughly, we'll call it 1810. That is how we're measuring our Fibonacci extensions. What we're saying is that this symmetrical triangle that is contracting has an apex in the next, we'll call it next few weeks here, or even actually, excuse me, next few sessions here, that this energy will be released. This explosive energy will be either a massive upward thrust or a massive downward thrust, thwarting the fifth wave, which we don't think that could happen. We're placing our bets that this triangle and all this compression and energy that's building up will lead or could lead to a 3,000 handle, or even higher, hitting some of these Fibonacci extension levels, maybe a 3349, or even all the way up to a 3768. What's happening to understand why we think Bitcoin could find the next wave up, calling it the fifth wave, is due in part to what the Federal Reserve and the central banks such as the ECB and the BOE are saying. They're basically going from this dovish standpoint this year, and in the very intermediate time frame, going into a very hawkish standpoint, and we're seeing drawdowns in stocks and bonds. Money has to go somewhere, and what you start seeing is you're starting to see money go into commodities. It's definitely not going into the dollar. What we could see is another tranche of money that is fleeing central banks, fleeing Wall Street, and end up in cryptocurrencies. So we see the compression, we see the energy. There just needs to be a spark. Maybe this stock and bond sell-off that we see, that is not just here in the U.S., but it's actually a systemic risk now as risk parity is unwinding. We see that in Europe. We see that in Japan. If we get continuations of that, we might have money flow into this triangle and lead to an upward thrust. As this triangle plays out, it's becoming a self-fulfilling prophecy, unless there's a big seller here ready to trip some stops. Otherwise, we see another leg up. What is very interesting, and we're getting headlines out there, some from Zero Hedge and some from other larger wirehouses, is that there are funds out there that are starting to set up their own private funds and buying cryptocurrencies. So these are financial institutions setting up funds to buy cryptocurrencies. We have said this before, and we'll say it again. This cryptocurrency push, you could be in the infancy. Imagine all the money unlocking on the sidelines, after compliance and after other regulatory bodies give it the A-OK, that you could see sovereign wealth funds. You could see pension funds. You could even see the likes of insurance companies diving into cryptocurrencies. And that could lead to another explosive growth. So as long as the current system is intact, as long as central banks are failing at producing producing sustainable growth, we will see cryptocurrencies have inflows as individuals attempt to escape the old system. Cryptocurrencies are merely ushering in a new system, a more decentralized way of how we create money, and away from central banks. Central banks have failed. We know that. And what we see in the response here is, I think maybe it's this year or it was the past few months, $1/10 of a trillion plowed into cryptocurrencies. That is not your mom and pop. Those are very big institutions, such as Fortune 500 companies using Ethereum, and we see that transition already starting. What's the takeaway? The takeaway is that there is massive compression in Bitcoin here, in this fourth wave contracting, which is creating a geometrical structure that we call a contracting wedge that's symmetrical. And the apex is any day now, which could lead to upside targets, which we have labeled up here, 3349, all the way up to about 3768 on a fifth wave. And that might be, it could even go higher if there was a fifth wave extension. So let's keep our eyes open. Let's be conscious and understand that the system, this old fiat system, is cracking, and we see a new system ushering in, which is cryptocurrencies.